There's a score attached to your name right now, not your credit score, not your social security record, not anything you can look up. A hidden internal score that banks, payment networks, and financial platforms use to decide how much freedom you actually have. This is the threat. You can do everything right on paper and still be treated as risky. You can have perfect credit and still be delayed, restricted, or blocked. And you will never be told why. This is the proof. Every day, people with strong finances suddenly face frozen accounts, failed transfers, extra verification, and unexplained reviews. And this is the promise. By the end of this video, you will understand how this hidden score is built, what affects it, and why protecting it matters more than most people realize. Now let us slow down. Most people believe there's only one financial score. Your credit score. You check it, you manage it, you try to improve it. You think it represents your reputation. It does not. Credit scores measure one thing: whether you pay debt on time. That is it. They do not measure how you behave. They do not measure how you move money. They do not measure how predictable you are. They do not measure how much compliance risk you represent. Banks need those answers, so they built their own system. Inside every major financial institution, there are internal scoring models. They do not show them, they do not publish them, they do not explain them, but they use them constantly. Every transaction you make updates that score. Every login, every transfer, every device change, every unusual payment, every dispute, every refund, every verification response, all of it feeds the model. Over time, the model builds a picture, not of who you are, of how you behave. That is the difference. Your credit score says, can this person repay debt? Your internal score says, can this person be trusted inside the system? Trust is not emotional, it is statistical. It is calculated, it is updated in real time, and it is never final. Now imagine what that means. You are being evaluated continuously, not yearly, not monthly, every day, every hour, sometimes every minute. Most of the time, nothing happens. The score moves slightly, up, down, sideways. You never notice. But when it crosses certain thresholds, things change. Suddenly you are asked for extra verification. Suddenly transactions slow down. Suddenly reviews appear. Suddenly limits shrink. It feels random. It is not. You crossed an internal boundary. Let me give you an example. Two people earn the same income. Both pay bills on time. Both have good credit. One moves money between accounts often. One keeps money mostly in one place. One sends international transfers. One stays domestic. One experiments with platforms. One sticks to one app. One disputes, charges occasionally. One never does. To humans, both look responsible. To models, they look very different. One looks predictable. One looks complex. Complexity lowers internal trust. Lower trust increases monitoring. Monitoring increases friction. This is how the score works. Not as punishment, as precaution. And here is the part most people never understand. You cannot check the score. You cannot request it. You cannot dispute it. You cannot optimize it directly. You only feel it indirectly, through delays, through reviews, through denials, through inconvenience. Imagine trying to improve something you cannot see. That is your reality. Now let us talk about data. Where does this score come from? It comes from everywhere. Your spending history, your transaction timing, your merchant categories, your device fingerprints, your IP locations, your login patterns, your income volatility, your account relationships, your peer networks, your refund behavior, your dispute frequency, your platform usage. Each data point alone means little. Together, they form a behavioral map. That map predicts risk, and risk determines freedom. Now think about how powerful that is. The system does not need to know your intentions. It only needs to know your patterns. Patterns predict probability. Probability determines policy, and policy determines what you're allowed to do. Most people never question this, because most people never hit the boundaries. They live inside safe patterns. Same job, same routine, same payments, same location, so their internal score remains stable. But the moment you change, the moment you travel more, the moment you try new income sources, the moment you move money differently, the moment you experiment, your score reacts, not immediately, gradually, quietly, until one day you notice something feels different. To understand how this hidden score really works, you have to stop thinking like a customer and start thinking like a system. Systems do not care about stories, they care about patterns. They care about probabilities. They care about outcomes. Every financial platform is built around one central question. How likely is this user to cause us problems in the future? Not today, not tomorrow. In the future. Everything you do is evaluated through that lens. When you open an account, the system assigns you a baseline score. It is based on your identity records, your location, your employment data, your credit profile, and your initial verification results. From that point on, the score evolves. Every action either reinforces stability or introduces uncertainty. Stable actions raise trust. Uncertain actions lower it. For example, Consistent income from one source, regular bill payments, predictable spending categories, limited device changes, rare disputes, few chargebacks. All of this increases internal confidence. Now look at the opposite. Fluctuating income, multiple income sources, frequent platform switching, changing devices, traveling often, using privacy tools, moving money across borders, high refund rates, frequent disputes. None of these are wrong. But each introduces complexity. Complexity increases statistical risk. Risk lowers internal trust. That is the formula. Now, here's something important. These systems do not judge behavior in isolation. They judge behavior in context. Sending money internationally once is normal. Sending money internationally every week changes the pattern. Buying crypto once is normal. Moving funds between exchanges frequently creates a profile. Changing devices once is expected. Changing devices often looks suspicious. It is not the action. It is the frequency. It is the rhythm. It is the deviation from your own history. That is what models measure. They compare you to yourself and to millions of others. Now imagine this happening over years. Your profile becomes more detailed than you realize. It knows when you usually spend. It knows how you react to security challenges. It knows whether you respond quickly. It knows whether you hesitate. It knows how often you contact support. It knows how often you complain. It knows how often you escalate. These things matter because they correlate with future disputes. Future disputes cost money, so they affect trust. Here's another layer. Networks. You're not evaluated alone. You're evaluated in relation to others. Who you send money to. Who sends money to you. Which platforms you use. Which merchants you interact with. Which services you subscribe to. If someone in your network is flagged, monitoring can expand. Not because you did anything wrong, because risk clusters. This is how fraud rings are detected. But it also affects innocent people. The system does not know intention. It knows correlation. Correlation drives caution. Now think about automation. Most scoring adjustments happen without human review. Algorithms update in real time. They learn from new cases. They adjust thresholds. They refine sensitivity. If fraud increases in a certain category, the model becomes stricter. If abuse rises in a region, monitoring increases. If disputes spike on a platform, users of that platform get scrutinized. You are affected by trends you did not create. You live inside statistical currents, and you rarely see them. Another important factor is velocity. How fast you move money matters. Rapid movement looks different than slow accumulation. Quick inflows and outflows suggest higher risk. Long holding periods suggest stability. Again, this is not about morality, it is about modeling. Now let us talk about feedback loops. Once your score drops slightly, friction increases, and that friction changes how you behave. Now, you might make more verification mistakes. You might contact support more. You might experience delays. Those delays create more data. The data feeds the model, which can reinforce the original assessment. This is how small issues become persistent, not because someone wants to punish you, because systems amplify patterns. Now consider this. There's no finish line. You never complete this score. There is no final rating. It updates forever. As long as you are inside the system, you are being measured. And because it is invisible, most people ignore it. They optimize what they can see. Credit score, savings, investments. They ignore what they cannot see. Behavioral trust. And that is a mistake. Because when problems appear, credit score will not save you. Balance will not save you. History will not save you. Only current risk perception matters. At some point, every hidden scoring system reaches a tipping point, a line you do not see, a threshold you are never told about. When your internal score stays above that line, life feels normal. Payments go through. Transfers are instant. Accounts feel reliable. Support barely exists. You are invisible, in a good way. But when your score drops below certain levels, everything changes, not suddenly, gradually, quietly. First comes friction. Transactions take longer. Reviews appear more often. Extra confirmations become routine. Limits shrink slightly. You tell yourself it is temporary. Then comes restriction. Certain payments fail. Certain platforms stop working smoothly. International transfers slow down. Large transactions trigger reviews. Cash outs get delayed. Nothing is officially wrong. But nothing feels easy anymore. Then comes classification. Internally, you move into a higher risk tier. That label is not visible to you, but it follows you everywhere inside the institution. Your account is routed differently. Your cases are reviewed differently. Your transactions are scored differently. You're no longer treated as standard. You are treated as sensitive. Once that happens, recovery becomes difficult, because every action is now interpreted through suspicion. Normal behavior looks risky. Small mistakes look serious. Minor deviations trigger major responses. This is how people get stuck, not because they committed fraud, because their profile drifted. Now let us talk about what pushes people into these tiers. It is rarely one big event. It is usually accumulation. A few disputes, some unusual transfers, a period of unstable income, multiple platforms, device changes, geographic movement. None of these alone matter. Together, they shift perception. Then, something small happens. A flagged transaction, a failed verification, a delayed response. That becomes the tipping point, and the system recalibrates. From that moment on, you live in a narrower corridor. Your margin for error shrinks. You must behave more carefully than before, but nobody tells you, so you behave normally. And that creates more problems. Here's where psychology enters. When friction increases, people get frustrated. They contact support. They complain. They escalate. They argue. They threaten to close accounts. They open new ones elsewhere. From a human perspective, that is reasonable. From a system perspective, that is instability. Instability lowers trust further, so the score drops again. Now you're in a feedback loop. Friction creates stress. Stress creates reactive behavior. Reactive behavior creates more friction, round and round, until people feel trapped. This is why some users say, "My bank hates me. My account is cursed. Nothing works for me anymore." It feels personal. It is structural. Now let us talk about recovery. Yes, it is possible, but it is slow, and it requires patience. Systems rebuild trust through consistency. Not explanations, not promises, not complaints. Consistency. Long periods of stable behavior, predictable income, reduced complexity, fewer platforms, lower velocity, minimal disputes, no drama, no escalation. Months, sometimes years. That is what it takes, because models need time to relearn patterns, and they do not forgive quickly. Forgiveness increases risk, so they delay it. Now here's the hardest truth. Most people never fully recover. They adapt. They open multiple accounts, they diversify platforms, they spread activity, they work around friction, they learn to live inside constraints. This becomes their new normal, and they never understand why it happened, because nobody explains it, and nobody has to. The system does not owe explanations. It only owes performance. When you look at this system from a distance, one pattern becomes impossible to ignore. It is expanding. Every year more data is collected. Every year more behavior is analyzed. Every year more decisions are automated. What used to require investigation now requires only correlation. What used to involve judgment now involves probability. This makes financial systems faster. It also makes them colder. Artificial intelligence is accelerating everything. Modern models do not just react to problems. They predict them. They simulate possible futures. They assign risk scores to people who have done nothing wrong. They estimate likelihood before action happens. That changes the nature of control. In the past, restrictions followed events. In the future, restrictions follow predictions. You're not limited because you failed. You are limited because you might. That is a fundamental shift. It means access becomes provisional. Approval becomes temporary. Freedom becomes conditional. Now imagine this logic spreading beyond banking. Insurance companies already use similar models. Employers use behavioral analytics. Landlords use tenant screening algorithms. Governments use digital identity systems. Platforms use trust scores. Everything is converging. Financial reputation merges with digital reputation. Digital reputation merges with social behavior. Social behavior merges with institutional access. Over time, one profile begins to influence all others. At that point, your hidden score is no longer just about money. It is about opportunity. Who gets approved, who gets delayed, who gets trusted, who gets restricted, quietly, systemically, without public debate. Most people will never see this coming, because it does not arrive as a crisis. It arrives as convenience, faster payments, smarter security, better fraud prevention, seamless verification. Everything feels easier until it does not, until you're on the wrong side of a model, until your profile shifts, until your access narrows. Then you realize how much power these invisible systems hold, and how little recourse exists. So, what does awareness give you? It does not give you immunity. It gives you strategy. It teaches you not to depend on one platform, not to concentrate all activity in one place, not to assume stability is permanent. It encourages diversification, redundancy, flexibility, long-term thinking. People who understand systems survive transitions. People who ignore them get surprised. Throughout history, power has always moved from visible structures to invisible ones, from laws to algorithms, from rules to models, from institutions to networks. We are living inside that transition, right now. This channel exists to map that transition, not to scare you, to prepare you, because preparation is the only real advantage left. If you understand how money, data, and control interact, you can make better decisions. You can avoid unnecessary friction. You can protect your options. You can stay adaptable. That matters more than ever. In the next video, we are going to expose the auto-freeze triggers, the specific behaviors that cause accounts to be locked automatically, often without warning, often without explanation, often without appeal. Because once you see those triggers, you will realize how fragile access really is. If you want to stay ahead of these changes, make sure you subscribe. Not for entertainment, for clarity, for resilience, for long-term survival in a system that is becoming more automated every year. Because the future belongs to people who understand it before it arrives.